HDFC as well is out with their earnings. Let's just get you the first details and what the first numbers look like, because we're expecting a PAT uptick of about almost 17% coming in for HDFC. 1135 is what our figure is for HDFC's PAT, and it will just come up for you on your screens. The stock meantime has gone completely soft. It was just about circling around and being flattish up until now, but it's about down 0.5%. HDFC's numbers, can we have the first numbers up on the screens? They will just come up. There you go, HDFC's earnings, PAT of 1150 crore rupees, and that is a little higher because 1135 is what we were expecting. That was what the ET Now poll was indicating. 1150 is where it's coming at. So largely you would have to say it is in line. Let's just wait by in terms of what the management commentary is on the NIMs as well as spreads. We're expecting the NIMs to come in at 4%, expecting a healthy dividend income as well, and the profit and sale of investment as well of about almost 820 to 850 crore rupees. Expecting the spreads to be largely stable at about 2.2%. Just have the first details on the first number. We are still awaiting what the NII figure is, because we're expecting an uptick of about 18.5%. It's just the PAT performance that has come in, which is coming at 1151 crore rupees, and this is comparable with the 1135 crore rupees that the ET Now poll was indicating. Neeraj, any other number from HDFC?
No, I think the bottom line is largely in line, maybe a few crores here and there, but two high quality companies trading at premium valuations, and you now know why, come out with numbers which are pretty much predictable by the market as well. So 1151 odd at PAT, so no complaints are there, close to 18% the kind of growth that HDFC has shown as well. I don't think the NII would be largely different. So the NII will come out. This is total income, of course, but the NII, my guesses would be around 18.5 to 19% growth as well. So no complaints on that front either. Good solid performance as expected from HDFC. You would almost call it boring, but boring which is really nice in a market scenario like this. So 18% top line growth, NII growth rather, 18% PAT growth. I don't think the NIMs would be too different either. So just about okay. There is, of course, an expectation of a profit or sale of investment, which I don't know would have come about or no, but we'll just wait for that, those numbers to come out as well. Just watch out for NIMs. They were close to 4%. I don't think there will be too much of a variation there. So both L&T and HDFC come out with good numbers. Of course, the reaction is fairly different. L&T is now up close to over 1.5%. HDFC not so much, just about stable at 751 odd. So that's really the verdict. We'll just wait for the NI number as well to come in. Of course, the total income at 5175, that is up close to 25 odd percent. So total income is up 25%. We'll wait for the NI numbers to come out. I don't think they'll be largely too different. 18.5 to 19%. Couldn't be more different from what has been coming out. So
just awaiting some more details in terms of what HDFC's performance is by way of their NIMs, spreads, as well as what is the NPA situation as well. So still awaiting those details, but yes, the street has given those earnings a thumbs up, because just a short while back, HDFC actually was down about 0.5%, and now the stock is actually recovering and nudging the green line at 752. That is where HDFC is. Like Neeraj said, a hugely institutional held stock, a steady performer at that. Yes, it may not be the most liquid of stocks, but again, steady performance is what the street rewards it for time and time again. So 752 is where HDFC is as of now. NII, 1633 crore rupees is what the NII is at. And again, that's largely in line, because the ET Now poll was indicating a figure of about 1643. 1633 is what they've delivered. So bang in line, both on the PAT as well as the NII performance. And that's largely an uptick of about almost 17.5%. Steady performance at that versus a comparable of 1386 crore rupees. So good performance, steady coming in from HDFC. Let's just wait by for what some other details are. That, of course, is Keki Mistry getting ready to address the media and talk about how HDFC's quarterly performance has been. But like we said, good going from HDFC. Would be interesting to see what the management commentary is like for the quarter as well as the quarters ahead. Can we cut across? We will just do that in just a few minutes from now. Meantime, back to L&T's earnings, because that is the one which the street has really rewarded this time on account of a very healthy performance coming in. Good numbers coming in from L&T. L&T is holding up. HDFC is recovering from the lows. The NII has come in at 1633 crore rupees. The PAT has gone up by about almost 15% or so. Let's cut across now to
the
Mr.
accounts for
Keki
the first
Mistry.
half of the financial year, and the accounts have been approved by the board. We had a very good quarter in terms of loan book growth. If you look at our total loan approvals in the first 6 months of this year, our approvals amounted to 50,435 crores, which represents an increase of 18% over the previous year. Loan disbursements during the 6-month period amounted to 35,196 crores, which represents an increase of 21% compared to the previous year. The total loan book as it stands on 30th of September stood at 1,55,128 crores of rupees, which represents an increase of 22% over the previous year. Now, if you break down that loan book into individuals and non-individuals, you will find that it's in the individual segment that the growth has been very high. And the individual loan book growth after selling loans grew by 24%. In the second quarter of the financial year, which is July to September, we sold loans aggregating in all to 2,518 crores of rupees. And in the last 12 months, we have sold loans aggregating to 5,630 crores of rupees. Now, these are all individual loans. So, had we not sold these loans, if you add back the 5,630 crores to the loan book, you will find that the loan book would have increased by as much as 27% compared to the previous year. And again, there, if you were to look at the individual segment increased by as much as 31%. So you would have seen that after several quarters, we've seen growth numbers go higher than 25% in a 6-month period. If we look at the increase in the loan book from 1st of April 2012 to 30th of September 2012, you will find that 78% of the increase in the loan book is because of individual loans and 22% is because of non-individual loans. So as I mentioned earlier, the thrust of business, the thrust of growth really has been individual lending during the 6-month period. As of 30th of September, we now carry a total loan book of 15,748 crores of rupees, which have been sold by us, but on which we continue to receive income. And the weighted average income we earn on this 15,748 crores is 1.4%. That income on that loans which have been sold is not taken into account while calculating the spread, but is taken into account in calculating the net interest margin, but it's not part of the spread. Our net interest income for the quarter, that is the second quarter of the financial year, stood at 1,634 crores compared to 1,387 crores in the previous year, representing an increase of 18% in the 6 months of this year vis-a-vis the first 6 months of last year. I'm sorry, this is for the second quarter of the financial year. If you look at the 6-month period, then the net interest income was 3,161 crores compared to 2,672 crores in the previous year, again giving a similar growth of 18%. So net interest income increased both for the quarter and for the 6-month period by 18%. Now, if you were to look at the net operating income, which means we look at the net interest income plus the sale of investments that happened during the period, then the net operating income for the second quarter stood at 1,728 crores compared to 1,473 crores last year, representing an increase of 17%. And if you look at the 6-month period, then the net operating income stood at 3,275 crores compared to 2,775 crores in the previous year, giving an increase of 18%. Net interest margin for the 6-month period stood at 4.2% against a margin of 4.3% in the previous year. So effectively, there's a marginal decline in margins by about 7 to 8 basis points. Spread, which is the difference between lending rate and the borrowing rate, stood at exactly the same level as it was in the first quarter, which is 2.27%. If we break down the spread into individuals and non-individuals, then the individual spread stood at 1.96%, the non-individual spread stood at 2.72%. Spread on non-individual business is higher than spread on individual business, but that is entirely a function of the fact that in non-individual loans, we have to make a higher standard asset provisioning. Provisioning for standard assets stands at 100 basis points, vis-a-vis 40 basis points for individual loans. Also, the capital that we need to provide is higher for non-individual loans vis-a-vis individual loans because the risk weight on non-individual loans is higher. So whilst the spread is higher at 2.72% versus 1.96% for individuals, if you were to calculate a return on equity, you would find that the differential in return on equity between individual and non-individual loans will not be significant. Coming directly to the profit figure, the post-tax profit for the quarter, this is standalone results, post-tax profit for the quarter stood at 1,151 crores of rupees as compared to 971 crores in the first 6 months of last year, giving an increase of 19%. If you look at the 6-month period, 6-month profits stood at 2,153 crores post-tax compared to 1,815 crores in the previous year, also giving an increase of 19%. So both for the second quarter of the financial year as well as for the entire 6-month period, post-tax profits standalone went up by 19%. On the asset quality front, we have seen another very good quarter, and we have now seen the 31st consecutive quarter where the percentage of non-performing loans was lower than what it was in the previous year at that time. So on 30th of September, non-performing loans stood at 77 basis points compared to 82 basis points in September of last year. So that's a 5 basis points improvement between September of last year to September of this year. We continue to be significantly over-provided, and you will find that the provision that we carry in the balance sheet on 30th of September stood at 1,748 crores of rupees. If you break down that provision between the provision relating to non-performing loans and standard asset provisioning or provisioning for the DRHL loans, you will find that the provisioning for non-performing loans that is required is only 493 crores. So out of 1,748 crores, only 493 crores is in respect of substandard assets or doubtful assets. Everything else is in respect of standard assets. And we are carrying a provision of as much as 1,255 crores on standard assets and on the DRHL loans. The DRHL loan provisioning will reverse on 1st April 2013. So against a regulatory requirement, the regulatory requirement for provisioning for us stood at 1,440 crores. So instead of 1,440 crores, we are actually carrying a provisioning which is 1.2 times higher at 1,748 crores. We continue to reflect all our investments in the balance sheet at historical cost and not at fair value. This is something we've talked time and again. The unrealized gain on our listed investments on 30th of June has stood at about 25,000 crores. That number has increased sharply in this quarter, and on 30th of September, the unrealized gain on our listed investments stood at 31,161 crores of rupees. If this 31,161 crores does not take into account the unrealized gain on unlisted companies like the life insurance company, the asset management business, the general insurance business, and so on and so forth. So the unrealized gain is entirely on the listed investments. If you were to look at the book value per share, our book value per share on 30th of September stood at 159 rupees. If you were to add the unrealized gain to the shareholders' funds only on the listed investments, the book value number would increase from 159 rupees a share to 361 rupees a share. If you were to look at capital adequacy, in the course of this quarter, the warrants got converted and we raised a little over 3,000 crores through conversion of the warrants into equity shares, and therefore the capital adequacy has gone higher. Tier 1 capital adequacy as we speak stands at 14.1%, plus we carry a Tier 2 capital which stands at 2.6%, giving us a total capital adequacy of 16.7%. And 16.7% is against a regulatory requirement of 12%. In fact, a Tier 1 capital of 14.1% is against a regulatory requirement of carrying 6% Tier 1 capital. So we continue to be highly well provided in terms of capital adequacy. As we mentioned to you at the end of the year, from this year onwards we started giving consolidated results, and therefore along with the standalone results we also have consolidated results. Very briefly to summarize, a consolidated profit for the year, for the 6-month period, stood at 2,851 crores post-tax, compared to 2,348 crores in the previous year, representing an increase of 21%. So that broadly summarizes the results for the financial year, and I'd be happy to take any questions.
So you put out a number for your margins in half-yearly sequence. Can you just tell us what was your margins quarter on quarter?
Last year, margins, when you're looking at the rounded figure, I told you that the margins stand at 4.2%, and last year margins were 4.3%. So in the June quarter, it was somewhere between 4.2 and 4.3. But if you look at spreads in June were 2.27%. Spreads for the whole of last year, April to March, also stood at 2.27%. So spreads have remained the same.
This year, this quarter is 2.27.
2.27.
So can you just repeat about the loan book? So how much has it grown?
See, the loan book growth, if you look at it purely on a balance sheet basis, the loan book growth is 22%. The individual component is higher by 24%. But this is after reducing the loans sold in the last 12 months. So that amounted to 5,630 crores. So if you add back the 5,630 crores to the loan book, assuming we had not sold, then the growth in the loan book would have been much higher at 27%, and the individual component would have been upwards of 30%. The individual loan book would have increased by 31%.
So, but what are your targets for as far as the loan book is concerned?
So we've always talked of a target of between 18 and 20%. We've historically talked of 18 to 20%. Historically, we've delivered numbers which are better than 18 to 20%.
Okay, and for spreads also, you will maintain the same?
Spreads, we said, will remain in the range of 2.15 to 2.35, more explicitly between 2.2 and 2.3. We've not seen any change. We don't expect to see any significant change.
And you are on course for the lending growth targets?
I'm sorry?
You are on course for the lending growth target of 18
At the moment, we are, as you can see, significantly higher than the lending growth target. Our growth, as I told you, after selling loans for the whole loan book, is 27%.
And so how is your cost of funds falling? Would we be expecting interest rates to be falling in HDFC?
I think HDFC's interest rates will follow where interest rates are in the system. So if interest rates in the system come down, naturally we will reduce our lending rates. We have a credit policy coming up at the end of the month. We'll have to wait and see whether RBI reduces rates or not. My personal view is that let's not get into whether they do it in October or they do it in November or December. In my view, by the time you get to March 2013, you'd probably be looking at interest rates which would be probably about 50 basis points lower than what they are today.
So, but with now government doing its bit, do you believe there is some pressure on RBI also to act?
Well, of course, there is. In the sense that RBI had always said that we would like to see the government take some action in terms of reducing the fiscal deficit before we start cutting rates. The government's done that. But at the same time, you have to bear in mind a couple of things. One is that inflation numbers have not come down. Inflation continues to be a big worry. So you see the rupee had touched 54 on Friday evening, and today also is hovering upwards of 53.80, 53.90. So a higher rupee means that the cost of import goes higher. And India is a very large importer of oil. So therefore, when costs go higher, it's going to put that much more pressure going forward. And that is what I think RBI would like to look at very closely. I think if the rupee had remained at 51, half 52 levels, I would have been a lot more confident of a rate cut straight away.
And have you seen the demand in the festive season picking up?
I've given you numbers for the last 6 months. You see that the growth has been very strong. I don't want to talk.
The last 1 month I'm specifically talking about because of the festive season.
Festive seasons keep happening all the time. We never saw a slowdown when there was no festive season now either. Our targeted growth, as I said earlier, was 18 to 20%, and in reality, if you add back the loans we sold, individual loans increased by 31%. The growth has continued to remain robust right through even post-September.
The one question which Simran asked basically on the cost of funds, the borrowing cost, basically what has been the scenario for this quarter?
So borrowing costs have changed over time, obviously depending on whether you raise short-term money or raise long-term money. Long-term rates have not come down as much as short-term rates. Our lending is largely long-term, and therefore unless we take a significant mismatch in funding, we have to raise long-term funding also. And long-term rates have come down marginally, but not very significantly. The good part is that we have again seen the development of a bit of a yield curve. We had a very flat yield curve in India till March. And the interest rate was almost the same whether you were borrowing 3-month money or you were borrowing 5-year money. In fact, it was more expensive to borrow short-term money than to borrow long-term money, which is never a healthy sign for the system. So that has corrected to some extent with short-term rates coming down sharply, and therefore we have seen the development of a yield curve, which I think is very positive.
And
How
how,
would have real estate prices been a dampener, especially if you see at your retail side? Because you've been pretty vocal about how.
See, real estate prices, we've always, you may have a different view depending on whom you speak to, but my personal view is that you're never going to see any big crash in real estate prices. Because the real estate prices are a function of demand and supply, like any other commodity. Demand in a country like India is always going to remain strong. It's the supply side which has to increase sharply if we have to bring property prices down. So you have to see a very dramatic increase in supply in order to enable a significant drop in real estate prices. But India is a large country. There are pockets where prices have gone up a lot. There are pockets where prices have not gone up so much. And therefore you could see some correction here and there, but no significant drop in prices. So if you ask me, my view, it is as good a time today to buy real estate as it ever was.
do you see a significant upsurge? Because given the way things are panning out, we are all seeing improvement in liquidity and also improvement in sentiment overall. So do you believe that can be an upsurge?
Upsurge in demand for housing loans?
Not in demand, in terms of prices.
In terms of pricing, I don't think you will see an upsurge. Again, it depends on places. In a place where prices have not gone up much, yes, prices could go higher if interest rates come down, sentiments improve. But I must tell you again that, and we've said this time and again, that even in a period when interest rates were high, the whole of last year and the first quarter of this year, we never saw a slowdown in demand. In fact, the demand actually increased. So interest rates, we've always said, has a much lesser impact on the demand for housing loans than the confidence level of the consumer. His confidence that his job is secure, he's going to get his salary at the end of the month, that is far more important in terms of the decision that he would have in terms of whether to take a loan or not.
You cut the spreads on some loans from October once, at least the individual loans. Where could we see it translated to something like an RPLR or RPLR?
It depends on how the cost of funds change. You see, every loan that we give is linked to a certain cost of borrowing, and unless that cost of borrowing comes down, it's difficult to change the PLR as you term it. If, however, there is a rate cut in the system, then everything comes down, then naturally that will also happen.
Will it have any impact on at least this quarter's spreads or in March?
I don't think so. It will come, rates will come, lending rates will come down when funding costs come down.
Okay, that's the HDFC management. Meantime, let's chat about MCX.